So the U.S. forecast, I'm not forecasting a second recession, but I do forecast a continuation of a depression, much slower growth than expected for the reasons I mentioned. And let me just kind of recap a little bit and go through some recommendations for investors. I recommend a decent sized allocation to cash, perhaps as much as 30% of your portfolio. And people go, well, wait a second, cash has no yield or practically no yield. What good is it? I want stocks or I want things that are going up. Well, okay, but cash has a lot of hidden benefits that people underestimate. One is that, first of all, it reduces the overall volatility of your portfolio. So if you have volatile assets over here like gold or real estate and other volatile assets like stocks and bonds, a slice of cash in the middle will reduce the overall volatility. So maybe you can sleep a little better at night. People worry about inflation, fine, but I would suggest that deflation may be a real problem, at least for the next year or two. And cash can be your best performing asset in deflation because the real value of cash goes up. But most importantly, cash gives you optionality. Obviously, based on what I've said, there's a lot of uncertainty, pandemic uncertainty, policy uncertainty, economic uncertainty. If you're the one with cash, you can pivot as visibility improves. In other words, if you're all in stocks and the stock market crashes, but you've got cash, you can go shopping in the wreckage. You can be the ones who picks up the bargains. Or if some other asset class collapses, again, the person with cash can buy those. First of all, doesn't lose because cash won't lose value, doesn't gain a lot of value except in deflation, but it won't lose value. But if something else does, you can come along and shop for the bargain. So that optionality, that embedded optionality is a very valuable aspect of cash. Residential real estate should do well. It should outperform, not for good reasons, by the way. It's because people are leaving the cities. The pandemic has taken it's left cities with all of the detriments, which are crowds, noise, pollution, crime, etc., but none of the benefits. The culture's gone. The museums are closed. The theaters are closed. The restaurants are closed. Okay, they're starting to reopen. Life is coming back a little bit, but cities have been pretty dismal places to be, and the population density is high, which there's still the residual fear of the pandemic. So people are just leaving the cities and going to the suburbs or even going to the country. And that is part of what's driving this residential real estate boom. So residential real estate is an attractive asset. Commercial real estate is not off the bottom. It's too soon to jump in, partly because of the work from home phenomena, partly because, depending on the market, social unrest. And a lot of tenants are out of business or can't pay the rent. So commercial real estate is something you might look at in late 2022 or early 2023. Too soon to jump in. I recommend a 10% allocation to gold, physical bullion, keep it in a safe place. It's protection against inflation, but gold actually does very well in deflation. During the Great Depression, longest sustained period of deflation in U.S. history, gold went up 75% from $20 an ounce to $35 an ounce. So people kind of get the fact that gold does well in inflation, but they are not as well acquainted with the fact that gold does well in deflation also, particularly in a period of low interest rates when gold's competing with notes for investor dollars. Low interest rates make gold relatively more attractive. High quality government notes, Australian government bonds, U.S. treasuries will continue to do well. Interest rates have not hit bottom. They're low, but they can go lower, and they will. Equities have a very strong bubble characteristics right now. Now, the problem with bubbles is they can get more bubbly. You can't just look at a bubble and short it. I don't recommend that. But you can be pretty sure the bubble will burst at some point, perhaps sooner than later, but not right away. The bubble can continue for a while. I mean, just looking at the U.S. equity markets, there's something called the CAPE ratio, invented by Nobel Prize-winning economist Robert Shiller and a collaborator. It's basically a PE ratio, price to earnings ratio, and you're all familiar with that. But Shiller does two things. Number one, he takes the 10-year average of the price to earnings ratio. And the purpose of that is PE ratios kind of go up during a boom and down during recession. And his view is take a 10-year average, and that will factor out the business cycle and give you more of a pure play on the business itself and the economy itself. And he adjusts them for inflation so you can compare the older data and the newer data. It's apples to apples. That CAPE ratio today is at the second highest level in history. The only time it was higher, the CAPE ratio basically means the price of the stock relative to the earnings. For a given amount of earnings, what multiple do you apply to get to the level of the stock market? But again, with these adjustments, they call it the CAPE ratio, cyclically adjusted price earnings. It's at the second highest level in history. The only time it was higher was before the dot-com crash, but you remember the dot-com crash? Our US NASDAQ fell over 70% in a couple of years. Right now it's higher than it was on October 1987, when the stock market fell 22% in one day. It's higher than it was on Black Tuesday in October 1929, when the stock market crashed and began the Great Depression. So I'm not saying it won't go higher. I'm not saying it's over. I am saying that is a nosebleed level, and no one should be surprised if the stock market crashed tomorrow.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
If you just take a straight price earnings ratio, not the cyclically adjusted one that Shiller does, just the S&P 500 price earnings ratio, right now, again, second highest level in history, higher than immediately before the Great Depression, higher than the dot-com, 3 times the long-term mean, 3 times the long-term median, higher than during the Roaring '20s. The only time it was higher was right after the global financial crisis, right around May 2009, when prices had taken off because we were kind of coming out of a bad recession, but earnings had not caught up. At that point, it got crazy. It was over 120 to 1, but right now it's 44 to 1. And again, that's the second highest in history, other than that one very brief anomaly. Dividends are the second lowest. Dividends to stock prices are the second lowest level in history. So by every measure, historically, recently, low dividend earnings, high PE ratios, high cyclically adjusted PE ratios, and other metrics, the U.S. stock market is in a bubble. It's very clear. But when will it burst? Well, it's hard to say, but the most likely scenario, so you have a narrative. So what's the narrative? There is no alternative to stocks. Bonds are low, gold has been kind of going sideways. Commercial real estate suffering, Europe's in recession, etc. So TINA, there is no TINA, there is no alternative. That's one narrative, a fear of missing out, FOMO, FOMO, fear of missing out. Who wants to go to a cocktail party or the club and have all your friends tell you how much money they're making in the stock market and you're not invested in stocks? So the social pressure to jump on the bandwagon is extremely high. The economic myths I busted earlier, the V-shaped recovery, not true, but people believe it. Pent-up demand, not true, but people believe it, etc. So there are these belief systems, these narratives, which are very powerful, which are driving the stock market higher. Plus the idea that you can't beat the market, which is not true, but a lot of people believe that also leads you to passive investing, index funds, ETFs, etc. What happens when money goes into an index fund? Well, they buy stocks. What happens if the stock price goes up? Some more money comes in. They buy more stocks and the price goes up. So you have a recursive function, a feedback loop of money coming in and prices going up. And it works, but until it goes backwards, and then it drops really fast. So the way I think about it, that we have a narrative driving the stock market higher. Earnings don't support it. Fundamental economic growth does not support it. The narratives do. So when will the narratives change? And my expectation is by late this year, perhaps November, we'll have second quarter data, we'll have third quarter data. We'll begin to see that the economic reality is highly divergent from the narrative, that the narrative is not true. It's not true today, but people think it is, and that's what's important, that's what counts. But when people can no longer pretend, when the reality catches up to the narrative and the narrative changes, then stock market values will change. So you might, the U.S. stocks will probably go higher, but I would say by late this year, and I'll use November as an estimate, it may be the case that the economic reality is caught up to the narrative changes and stock markets crash. Bitcoin's a Ponzi, it's not a form of money. It's a pure speculation. I prefer roulette, but if you want to buy some, knock yourself out, but it could, by the way, I wrote about this last month and I said, what I'm saying right now, this is not a view formed because Bitcoin had a bad week. It did have a bad week. It was down almost 50% from high to low over the past couple of weeks. But independent of that, I mean, Bitcoin could go back to 100,000 or higher, or it could go down to 10,000. There's no way of knowing. And that's the point, really. It's not a store of value. You can't spend it. It's not money. And it's not a unit of account. It is what it is. The real danger of Bitcoin is not that the price goes down. It's that it disrupts our linear way of thinking with regard to money in general. That Bitcoin will not replace the US dollar, but it may destroy the US dollar by destroying the concept of money to the point where, is it a video game, or is it real, or what is money? And once you get into that world, and we're kind of in that world, we just don't realize it. It's, so the old saying, we don't know who discovered water, but we know it was not the fish, because the fish is in the water and doesn't know about water until you take it out. We're in the world of Bitcoin, and everyone's spun up about price and blockchain and all that stuff. That's all content. It doesn't really matter very much. But what does matter is the water, the electronic environment that we're in, the immersion, the water around the fish, which is destroying the idea of money. And that may have consequences that go way beyond Bitcoin.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.